Now, here's the next one, which is kind of a one that we do a lot of because we get that additional bigger profit zone because of the diagonal part of the spread. So this is the calendar diagonal. So this one was going to be using a put again on QQQ. So this was a short trade. Okay. Again, defined risk trade, defined as a debit paid. We're selling time and volatility. Great for directional target trades. We're getting income and getting paid while we wait if we need to wait longer for the direction to kick in. But a big positive plus here is you get a greater profit than you would with the income calendar because of the diagonal part of the spread. So trade duration 1 week to a month are typical timeframes that we'll look at. Again, positive theta. So this is one we did. This was just, this one really nailed it. This was the super big home run. So this was a QQQ long put calendar set up on the 7th of October. QQQ was trading at 274.75. Did a couple adjustments and adjusted this down to a very small amount of capital at risk. So you can see here, new QQQ short trade at 274.75, breaking down after today's non-farm payroll number came out, looking for a retest of the lows. So buy a diagonal 19 October, 10 October, 274, 269, put calendar diagonal at around 540. So that was the initial setup, and then we adjusted it one time to really low cost, which you'll see, and then had a huge profit on this one. With spreads, you chip away, singles, doubles, and occasionally you get these massive home runs. So we did the adjustment here, set up on the 7th, then adjusted it to a put calendar diagonal, but rolled down the long and short strikes, okay? So then took profit on the 13th when it's trading at 256. So what we did with this adjustment, we were able to roll this down. We had amortized down the cost, and we rolled the spread down. We had a spread cost now of $50. That's it, max risk. So we started out with the wider spread that let me back up, 260. Let me show you here. Let me move back up just a second. I'll show you. The original trade we set up, we were long the original trade. We were long 274, 269. Okay, then we adjusted it down, rolled it down, and now we were long the 267, 258. Had a huge profit from rolling it down. So that amortized and reduced our cost of the trade down to $50. And then you can see on the 13th right here, this trade was just ripping on the downside. It was trading right there. So it's trading at 256.68. So the spread went from that adjusted 50 cents to now 7.94. So we were up $734. So this is over 1,000% return, 1,468. So that's, what you can do with these spreads, just have so many great benefits to the trade. So that's a look there.